Live from Sydney, this is Inside with me, Paul Allen, where we dive deeper into the stories that matter with crucial context and sharp analysis. Rio Tinto and Glencore resuming talks to create what could become the world's biggest mining company with a combined market value of more than $200 billion. So what is driving the desire for such a mega-sized deal? We'll explore the reasons with Natixis CIB's APAC Head of Investment Banking, Raghu Narain. Asian equities stumble, led by technology shares as markets brace for the US payrolls report and a possible Supreme Court ruling on President Trump's tariffs. And investors continue to digest US moves on Venezuela, with nearly 20 oil executives set to meet President Trump on Friday to discuss rebuilding the country's energy sector. Meanwhile, Bloomberg learns that China plans to approve imports of NVIDIA's H200 chips as soon as this quarter, renewing access to a critical AI market. And Louis-Vincent Gave, CEO of Gavekal, will connect all of those dots for us, from mining mergers to geopolitical tensions and AI breakthroughs. China's consumer inflation accelerated last month at the fastest pace in nearly 3 years, and the upswing was largely driven by higher food costs, marking deeper deflationary pressure. The consumer price index rising 0.8% from a year earlier. China's core CPI, meanwhile, grew 1.2% for the third straight month. Bloomberg Intelligence says today's data is unlikely to prompt immediate action from the PBOC. And here's a look at what else to keep an eye on today. Traders will be tracking the latest job numbers due out of the US, with a global bond advance stalling ahead of that data. As investors assess the likely path for interest rates, money markets are pricing in at least 2 quarter-point Fed cuts this year. Now, the US Supreme Court is set to issue the first decisions of 2026 on Friday. That means legal challenges to 3/4 of President Trump's tariffs could finally be resolved. Still, a ruling against the trade barriers is unlikely to spell the end of the policy. Trump may attempt to replicate most tariffs using alternative trade enforcement authorizations. Also, oil in focus as President Trump prepares to host a who's who of the U.S. oil industry at the White House. Trump says oil companies will spend at least $100 billion in Venezuela as the U.S. government moves to control the Latin American nation's crude riches. Oil traders are also weighing President Trump's latest threat to Iran, warning that he would hit the country hard if the government kills protesters. To break all of this down, let's bring in Stephen Stapczynski, who leads our Asia energy coverage. And Stephen, we're seeing some gains for oil today. Is geopolitics back in the driving seat when it comes to prices?
I mean, it never left the driving seat. I think so far, over the last few weeks, the market has been really focused on Venezuela and the potential for them to pump more oil, and the Trump administration may be reducing their enforcement of sanctions, which could allow for more oil to maybe come into the market. But at the same time, you also have to weigh what's happening in Iran. With the events that are happening with the Trump administration discussions, Iran is a major producer of oil, and while they are sanctioned by the U.S., they do ship a lot of it on Shadow Fleet vessels, so it makes its way into the market. If there's any stricter action on Iran, if the U.S. were to kind of up the ante there, maybe that could reduce output. It could maybe even disrupt production if there is some sort of military intervention. I think that's everything that the traders are sort of looking at the moment. But if you take a step back out and you look at the macro view for the market, I'm talking about just supply and demand, we're in quite a bearish place, right? Oil prices are already at the lowest level in years. We're entering a year that the IEA calls one that will develop into quite a glut of supply, right? OPEC Plus has been adding output through last year. They're taking a pause right now, but they could add more maybe through the second quarter if they decide to do so. U.S. oil output has also been quite strong. So there's plenty of oil on the water and being produced. It's just a matter of how do these geopolitical events sort of change the short-term view of trading desks, and you're seeing that play out in real time with prices up a bit, around $62 for Brent.
Yeah, well, you mentioned supply and oil already on the water, and I mean longer term there could be even more of this should Venezuela's enormous oil reserves be realised. And I mean that's the purpose of today's meeting or tomorrow's meeting US time between US oil executives and President Trump. What's the message from President Trump to these executives, and what are they likely to say in terms of the viability of some of the investment that he'll be asking for?
I think the message from Trump is pretty simple. Invest in Venezuelan oil and you'll make money, is what he's saying. Now, the situation, I think I need to give a little bit of context on that, right? Venezuela produces about 800,000 barrels per day of crude oil right now. Now, in the early 2000s, it was closer to 3 million barrels per day, and in the 70s, it was 4 million barrels. So the idea is that Trump wants to get back to the glory days. He wants to revive that output and essentially triple or quadruple production from Venezuela. That's a pretty sizable amount. Right? Venezuela right now produces less than 1% of global supply, but if you double or triple that, you are talking about a sizable increase into the market. Now, that all being said, the reason why oil output is at 800,000 barrels per day and why it has declined over the last 2 decades is because of years of lack of investment, of the infrastructure deteriorating, corruption, theft, damage, rigs being taken off the ground. All of that together means that in order to recover that output from Venezuela, some analysts are saying it will require $10 billion of investment per year for a decade. This is not something that's going to come online tomorrow. This is something we're talking about in the 2030s. And Trump wants this to come online as soon as possible, right? He wants more oil on the market for a few reasons. One, he says he wants to make money. He wants the U.S. to profit off of this. He will share the profits with the current government in Venezuela, but he's been very transparent that he sees that these resources provide enormous potential in economic gains. On the second thing is Trump wants lower oil prices. Yes, Brent is at $62 a barrel, but he said recently that he wants it more closer to $50 a barrel. And to do that, pumping more oil into the market from Venezuela, while it would be challenging over the short term, over the long term, would help to reduce oil prices and help ease inflation. Now, I think the one thing that we're going to have to watch out for from the big oil executives on Friday is how willing they are to actually invest in Venezuela. Because if you look at the geopolitical situation, why not just invest that same money in a sure thing like shale, or maybe another country where the geopolitical situation isn't as tenuous? Now, and then lastly, just prices. Oil prices are low. Why do you want to invest now?
All right, Bloomberg's Stephen Stapczynski, who leads our Asia energy coverage. Still plenty of question marks over the oil situation in Venezuela. We'll have more on that for you tomorrow. Well, investors are also bracing for the US payrolls report and a possible Supreme Court ruling on President Trump's tariffs. Bloomberg MLive strategist Mark Cranfield joins us now for the market action. And Mark, we saw a little bit of a rotation out of tech in the US. That theme doesn't seem to have the same endurance in Asia, though. What are we watching? All right, we're having a little bit of trouble with Mark Cranfield's audio there. We'll attempt to come back to him a little bit later in the show. But let's get a little bit more on market insight with Ankita Pathak, now head of global investments at Ionic Asset. Ankita, we were just hearing from Stephen Stapczynski, our energy reporter, a moment ago, talking about some of the macro risk around oil prices. But of course, that's not all. I mentioned the Supreme Court potentially ruling on President Trump's tariffs, jobs and inflation data coming out also, and how that relates to Fed policy. How is all of this macro risk factoring into the themes and the sectors that you're watching?
Hi, morning. Good to be here. And I think if there is one theme for 2026 that I am bracing for, it is increased volatility. 2025 really was a trailer in that regard. I mean, the volatility probably stood at about 25 times in 2025 versus 18 times in 2024. And I think daily volatility could be even worse as we step into 2026, and for the reasons you mentioned. Uncertainty around oil. Secondly, the Supreme Court ruling today. Now, there are two possibilities. If the ruling is in favor, I think markets will not rejoice it as much, because then it gives President Trump more power to wiggle around with International Emergency Economic Powers Act. On the contrary, if the ruling says no tariffs, markets could show slow joy, but again, the uncertainties would then linger for longer, because there are provisions in the Act under the national security tariffs on China where there could be more negotiations going forward. So all in all, I would say highly volatile period. In terms of the space that we watch, which was innovation spending across economies, we think right now looking at sectors which act as tariff defensives is a good idea for investors.
I believe we have Mark Cranfield back with us now. So, Mark, I just want to get to you as well, if I can. I mean, we are waiting on a potential ruling, as mentioned, from the Supreme Court on the legality of President Trump's tariffs. In the bigger picture, how much does it really matter, considering there could be other paths to applying trade pressures?
Well, certainly for the U.S. Treasury market, it could be a very big swing factor in the short term. If you look at the pricing of Treasury yields, the 10-year yield is only just above the 4% area, even though you've got Fed funds rates only a few basis points lower than that. So it really is a much flatter Treasury curve than you would expect in a country where the fiscal deficit is rising in the United States. And so a big part of that is investors have priced in the fact they do expect some revenues on the tariff front to keep yields down. So if you take away that potential income, it certainly is the Treasury market would have the chance to respond quite aggressively. And you may see the yield curve steepen quite a lot, which will be pretty inconvenient for President Trump, who's trying to get down mortgage yields. He's been intervening quite aggressively, saying that the mortgage companies should buy $200 billion worth of mortgage-backed securities to try and get home loan rates down. Well, the tariff ruling going against him would certainly disrupt the yield curve in the Treasury market, and by knock-on effect would certainly hurt the mortgage market as well.
And just to go to another wild card here, I mean, we do have a Fed meeting this month, but we're not anticipating any change. But there are a few conflicting signals for the Fed to consider in terms of inflation projections. Also, the clean jobs report we're getting tomorrow. But the Atlanta Fed had a fairly optimistic survey as it pertains to growth outlook in the U.S. as well. So it really does underscore the divide here. And at the same time, Trump appointee Stephen Myron wants to see 150 basis points of easing. So where is this heading?
I mean, on the surface, it looks as though we're going to have another very split meeting. And the past couple of Fed decisions have failed to get unanimous verdicts from all the different Fed members. Some looking for big rate cuts, some looking for small rate cuts, some looking for no change at all. That probably isn't going to change a great deal. Today's jobs report, if it's a really soft, weak number from the jobs, that would certainly help people that want to go for an interest rate cut. But we also will have an inflation report to digest before they meet later in the month. It's not going to be easy to get a clean decision. The way the Federal Reserve have been speaking and voting recently, it looks as though it will come down to the wire once again. It will also matter whether or not President Trump announces who's going to be the next chairman of the Federal Reserve as well. Investors are looking for that. That could sway the decision of the next meeting as well. There's a lot of things up in the air. I would suggest that traders are not going to take the Fed meeting too seriously from a positioning point of view until much closer to the day. They'll want to see all that data. They want to hear from President Trump, and then they will make up their minds how they're going to trade that next Fed decision.
Ankita, against that backdrop, we are seeing a little bit of US dollar strength at the moment. It's hit a 2-week intraday high, pushing up against the 100-day moving average now. Is this prompting any reconsideration around allocations for EM Asia this year?
Well, I think it's on the margin. If we were to take a longer term view, we do think there are more reasons for dollar to depreciate than to appreciate. And that would probably be the theme of 2026. Reasons, of course, are, increased M2. Fed would probably have to cut interest rates going forward. And, the movement away from dollar assets into precious metal really exacerbates the fall of dollar. So while I'm not in the camp of a very sharp fall in dollar, but I believe as we progress through 2026, dollar weakness gets worse from here than better. There could be periods of appreciation like today, but I think those are short-lived and very event-based.
How do you see some of these pressures transmitting to your clients in India?
Of course, I mean, I think clients in India have always, I think they have embraced gold and silver rally more probably than global peers. An average portfolio in India would probably have taken about 10-12% exposure into the precious metal themes. And obviously, precious metal today has become the risk-off asset per se. It is not US bonds, it is not dollar, it has rather been precious metal. Central banks are buying it. Clients have been asset allocating. If we look at pure numbers in India, the flows to equity funds have contracted, but the flows to multi-asset funds, commodity funds have actually done very, very well back home in 2025.
In terms of Indian assets, which are looking most vulnerable to you to some of these global shocks we've been discussing, and which ones have strong buffers in terms of decent balance sheets and good exposure to the domestic story as well?
See, India will remain a story of consumption and discretionary consumption more so. Premiumization is a huge theme back home, and I think that consumer discretionary plus capital markets does remain a strong domestic story in India. But very honestly, India has not gotten the FII love in 2025. The domestic investors have given a floor to the market, but the rocket fuel that the Indian markets require usually comes from foreign institutional investors, and those have been missing in 2025. I think two key reasons for it. One has been slowdown in our own earnings growth. And second, of course, the US trade deal, which is yet to be finalized. So a lot of lingering volatility as far as the India-US trade relationships are concerned. I think those two have weighed in on the floor, which is why probably if you do ranking of the emerging markets by performance in 2025, India would probably end at the lower quartile of the league of the charts. But I think if the two factors turn, 2026 could turn out to be a good year.
Mark, I just want to get some final thoughts on you, because Ankita, they're mentioning gold, which does play an outsized role in a typical Indian portfolio. But we're seeing it back off a little today. But in terms of some of the risks we've been discussing here, is JP Morgan's $5,000 price target now looking a little bit more realistic?
Yeah, I think people are taking that pretty seriously. If you look at the conditions which have brought gold to where it is now, they're still going to be in place for some weeks, probably even months ahead. So you have an environment where the US interest rates are relatively low. They may go lower again. Federal Reserve is priced to cut rates this year. US dollar is slightly on the weak side. And at the same time, you have a very high anxiety situation in terms of geopolitics. So whether it's to do with the United States and Venezuela, Russia, Ukraine, China, Taiwan, most parts of the world are in play in terms of that level of uncertainty, which is also very supportive of precious metals as well. So it's not just gold, we've seen silver and platinum performing very well also. So all of those things look as though they're going to stay on the radar, maybe even get more extreme in the next few weeks and months. So all of this definitely very much the case that it plays into people that want to use hedges for gold and for silver as well.
All right, Ankita Pathak, Head of Global Investments at Ionic Asset, and our own Bloomberg MLive strategist, Mark Cranfield there. Thanks to both of you. Up next, our exclusive conversation with Cambodia's Deputy Prime Minister on the nation's fragile ceasefire with Thailand and the tariff negotiations with the US. This is Bloomberg. Cambodia's Deputy Prime Minister says the country wants to lower the temperature in its dispute with Thailand to protect a fragile ceasefire. Speaking exclusively to Bloomberg, Chanthol also pushed back against Bangkok's assertions that the clash was part of a battle against scam centres operating across the border.
Well, the ceasefire is still fragile, but I want to reassure you that Cambodia committed to the ceasefire. Cambodia needs peace, and I'm sure Thailand also needs peace in order to build our country, our respective country, for the benefit of our respective citizens. So we are committed to resolve the conflict through a peaceful means. We have different mechanisms in place. We have GBC, General Border Committee, we have JBC, Joint Boundary Commission. Cambodia and Thailand will be neighbor for next thousands of years. So let's work together to develop our economy for the benefit of our people, for the benefit of ASEAN. We cannot have a conflict or else we lose the credibility of ASEAN. So I hope and I wish that this conflict can be resolved peacefully, sooner rather than later. And I'd like to take this opportunity also that we need to lower the temperature. The Cambodian citizen, also the Thai citizen, let the government work together to find a peaceful resolution. Do not add fuel to the fire.
Last year in April, Cambodia was among the top of the list of President Trump's tariff rates. It was very high, over 40%. You led the negotiations for Cambodia. The rate is now 19%, much lower. Now that a few months have gone by, I do wonder what has been the economic impact of those levies so far.
2 days after the announcement, our Prime Minister sent a letter to President Trump, offered to discuss, to negotiate in good faith the trade between Cambodia and the US. I believe that Cambodia was the first country that concluded a comprehensive reciprocal trade agreement between Cambodia and the US. Now, we are continue to discuss with USTR regarding certain sector that we believe should receive a lower reciprocal tariff. For example, the garment, the textile, the footwear, travel goods that employs nearly 1 million workers, predominantly women. So we ask USTR to reduce those important sectors for Cambodia for potentially reducing or zero out those sectors. It's important for Cambodia.
Cambodia's Deputy Prime Minister Chanthol speaking there to Bloomberg's Philip Hymans. Let's take a look at how benchmarks in Southeast Asia are tracking at the moment. We are seeing some broad-based strength. Singapore's Straits Times Index, one of the best performing, better by 0.7% right now. We're one of the standouts of 2025 was, of course, Vietnam, but Indonesia did pretty well too. Better participation there. It did lose a little bit of momentum towards the end of last year, but we're seeing stocks in Indonesia also advancing by about 1/3 of 1% right now, while stocks in Manila better by 2/3 of 1%. Still to come, Rio Tinto back in talks with Glencore on combining to form the world's biggest miner. We'll have what this means for the sector next. This is Bloomberg. Welcome back. You're watching Insight. Let's take a quick look at where markets stand. Mainland Chinese markets heading to lunch. Japanese traders, meanwhile, returning from their break. And this is how things look at the moment. We're seeing a broad-based rally across most of the major markets. The Nikkei having another good day, better by 1.1%. Yen weakness still very much a theme, 157.21 for the Japanese currency at the moment. The Hang Seng flat. We do, of course, have a pretty decent IPO or a debut of Minimax. We'll bring you more details on that a little bit later on. Elsewhere, the Kospi having another good day as well. Tech initially struggled as we saw something of a rotation at the start of the day, but not really seeing a repeat of what played out in the US markets. Now, we're also tracking Rio Tinto. Shares currently somewhat weaker at the moment, off by about 6%. And this is after news broke of a resumption in talks to buy Glencore, a transaction that would create the world's biggest mining company. But Rio stock not responding well to this news at the moment. Metals and mining reporter Martin Ritchie joins us now from Shanghai. Martin, details thin on the ground, but this isn't the first time this conversation's been had. What more do we know about this potential Rio Glencore tie-up?
Not a lot, as you say, and I think that's probably one reason why the shares are down so solidly this morning. You know, it's all we know is that the companies are in talks again. They were talking to each other back in 2014 about a combination. Now they're discussing it again, and they have until February the 5th, according to the UK rules. Rio has until the February the 5th to decide whether to go ahead with a formal bid for Glencore. This is primarily about copper. There's been a lot of deals in the copper space, or attempts to make deals in the copper space over the past 2 years. Rio has a new CEO, a relatively new CEO, who obviously might want to make his mark in deal making. Glencore has been pitching itself as a big future copper producer, and so those two things are coming together, but it's not clear exactly what will happen over the next few weeks.
Yeah, well, in the absence of facts, we are left with speculation. So let's take a look at what the market thinks a potential tie-up could look like. I mean, where are the synergies here? You mentioned copper, but I guess the elephant in the room is coal, which Rio has exited and Glencore's very much in.
That's right, yeah. So the positives are, I mean, the big thing is on copper, but there's a lot of complications with regards to this transaction. Coal being the big one. Glencore, one of the world's biggest coal suppliers. Rio has already exited coal. And so they're going to have to come to an arrangement, and what happens with those, whether it's a divestment before the takeover or some kind of restructuring after, and that's going to be one of the key questions that investors are looking for answers to. Aside from that, there's other complications. Rio has a dual Australia UK listing. The cultures of the two companies historically have been seen as somewhat different, and one of Rio's biggest shareholders is in China, Chinalco, and we'll have to sound out what their opinion is about a potential big transaction like this.
All right, metals and mining reporter Martin Ritchie there. Well, joining us now is Raghu Narain, head of APAC investment banking at Natixis CIB. Raghu, thanks for joining us, and I do want to pick up on what Martin was talking about there in terms of the Rio Glencore tie-up. Obviously, we're a bit light on details at the moment, but can you talk to us about the synergies as you see them and how appealing an opportunity would look to you?
Yeah, sure. Thank you, Paul, for having me here. And what I would say is, first of all, this is a classic example of a big thematic we have seen unfolding starting last year, which is mega mergers. And there's so much happening in this industry and in this deal as well. So first point is the mega merger point. The second thing is, why is that happening? It's a function of gaining scale. So both these companies have been looking at each other for a while. This is the kind of deal that is not cooked overnight. It's been going on for a while. And there's a lot of conversations in the boardroom to assess the synergies and the product complementarity, which is really where the industrial logic of this deal comes about. Obviously, Rio is big in iron ore, and you've got Glencore with the copper exposure and other metals. There's also geographic dispersion here because Rio's heavy Australia exposure, and then Glencore's got more of the non-Aussie exposure. So one can think of the industrial logic being product complementarity as well as geographic diversification. I think there's another point that's happening here is that the industry is in play. And when that happens, you do see these kind of deals unfolding. We had seen Anglo-Tech happen. That's a deal that went through. So there's competitive dynamics that get put into play when in an industry when these kind of deals go through. So there's partially that at play here as well.
Yeah, you talk about mega merger. I mean, this combined entity would account for something like 7% of total global copper production, so it would be very large. But, in this environment of extremely strong metals prices, do you expect to see some more of this kind of thing? Are there any potential deals on the horizon that you think we might see in 2026?
Yeah, so in metals and mining, there is a lot happening in the industry. And one of the things, one big theme is that the China outbound activity actually is very much concentrated on Chinese acquirers looking to acquire not just copper, but lithium, gold, nickel. Part of it is also a view on the commodity prices, but part of it is that these are inputs that are needed for industrial production, and in particular for the EV value chain, which is very important to China. So we see a lot of that happening. We can also see scale and efficiency-driven mergers that will happen in the industry going forward in 26.
It's interesting that you mentioned China because a lot of China's state-owned enterprises have been divesting some of those underperforming overseas assets. Do you see that trend continuing, and where is that money going to get put to work instead?
Yeah, so compare the point I made about China outbound going on as Chinese acquirers in metals and mining and also infrastructure. We have also seen in the last few quarters this move to actually sell non-core or non-performing assets where the synergies have not been realized by Chinese who had acquired these assets. And that's, across infrastructure, across healthcare as well. And so what we do see that happening is that capital is then going to get recycled. And I think part of that capital is going to go to shore up the balance sheet, to enhance the liquidity. And part of that is also going to be for the winners in the China domestic market, for them to undergo domestic consolidation, which is also very actively happening in the China domestic market.
A lot of China's outbound activity also often focuses on Latin America. Do you see maybe a reconsideration of that approach, considering the recent U.S. operation in Venezuela?
Yeah, that's a very good point, Paul. And look, I would call that into something that we have talked about in our investment outlook is a VUCA world. So volatility, given what's happening with the policy and political actions, uncertainty given what's happening in the tariffs and the macroeconomic context, higher rates, as well as some of the currency depreciations. That all leads to uncertainty, where we see that companies, and particularly in cross-border acquisitions, the geographies that were previously open and are now being challenged. And Latin America story is part of that. All of that leads to ambiguity. And that ambiguity is which creates a headwind or a downward pressure on M&A volumes or M&A deal flow. So when you look at the Latin America story, as you talked about previously, when the China-US and China-Australia trade flow collapsed, given the geopolitical environment in this VUCA world, now what we see happening is that LATAM, that was a preferred route for Chinese acquirers to acquire resources, companies, etc., is now being challenged. And it would unfortunately reverberate through the rest of LATAM, where it would be really critical for Chinese acquirers to examine the risk of these type of things happening, where they may be hindered from doing acquisitions or may have to unfold what they have done and reshift their supply chain and reshift their technology presence as well.
I just want to switch gears, if we can, back to consolidation. And I mean, another space we might look at in this regard is artificial intelligence. Do you anticipate to see some M&A in this space as well, particularly when we consider the enormous capex requirements that currently seem to be getting demanded?
Yeah, absolutely, Paul. And AI is, sort of central to the 2026 M&A outlook. And AI is not just about AI itself, it's also about the ecosystem around AI, which is data centers, which is power, renewable power as well, components, as well as the ancillaries that go around that. So when you unpack that, of course there's tech and data center AI related activity that we see, which is going to continue to happen as AI adoption increases dramatically. But also, if you look at digital infrastructure and data centers, which are necessary and exist in the physical world for AI to actually operate, we see a lot of activity that's happening there. And that's kind of from early to mid stage. And it takes really two forms. You have joint ventures in APAC, where you have the global operators looking to deploy their expertise, and you have incumbent players in Asian countries who have access to land and electricity, which are the two other components needed for data center operations. And that joint venture type of deal flow is accelerating. We also see some large-scale DC deals that have happened, which enable the whole AI ecosystem. AirTrunk was an example of that. And then the race for renewable power to actually power these data centers and thereby enabling the AI models happening. I think one important point to note also is the kind of deals that are happening in the IPO market. And today we have seen, in the last 2 days, we've seen significant activity from Chinese AI players accessing the public markets, and that's really good news. And I think it just creates a more of a virtuous cycle between M&A and the equity markets, promoting this whole AI ecosystem.
Yeah, do you see some of these potentially getting a tailwind from U.S. trade policy as well, with perhaps the Trump administration using some of its trade policies to boost investment and consolidation in tech between some of its allies that run trade deficits? I'm thinking mainly of Japan here.
Yeah, absolutely. Absolutely. So if you look at the Japanese outbound over 2025 and also expected in 2026, there is heavy tech outbound into U.S. There's artificial intelligence outbound. There's obviously, again, parts of those value chain being invested by the Japanese. So clearly, back to the VUCA concept, the policy environment of countries actually can support or hinder the deal flow. What I would say, Paul, is that 2026 is a year where where companies do want to do more M&A deals. There's a lot of pent-up demand. There's a lot of private equity that we can talk about as well. There's a lot of pent-up demand. There is just this real downward pressure that arises from this VUCA world, which creates that downward pressure. So as these policy implications or policy announcements actually make things a lot more visible, you will see a lot more deal flow happening in 26.
Raghu, just before we let you go, look, India is often seen as a bright spot for APAC M&A. What are you watching there for deals this year?
India is going to be very interesting. First of all, the public markets are going to be very active. Now, one thing to consider in India is that India public markets are trading around 24, 25 times. So for M&A acquirers to enter into India, one has to be careful with the entry price because valuations are pretty hefty. That said, the secular growth themes enabled by the infra development, the technology development, and most importantly, the amazing demography and the consumer spending power that's there leads to a lot of inbound M&A activity in India. Private equity focus in India is high, and therefore, there's will be a lot of private equity acquisitions, but also they are able to take money out through exits which are happening through M&A and capital markets, which has been maturing over the last couple of years. So we see a lot of that happening. There's been select outbound activity from India as well, particularly in healthcare space, where really giant players in healthcare space have reached market saturation point in India, and now they're looking for growth opportunities in Europe and US. So India is going to be pretty interesting. Of course, consumer tech, financial services will be the other sectors besides energy transition and data centers where we will see a lot of M&A activity in India.
All right, Raghu, Narain, Head of Investment Banking APAC at Natixis CIB. Thanks so much for joining us today, and perfect timing as well. India markets have just opened for trade this Friday. Let's take a look at how we're tracking. A little bit of softness in some of the markets, although I think I saw the Sensex just turning modestly positive. There we go. Now all the indexes, just a few points in the green there. We are watching the fortunes of Vodafone Idea. News out today that it's spectrum dues, which include interest and penalty payments for the fiscal year 2006 to 7 through to 2018-19, you're going to be frozen as of December 31st last year. So some certainty there for Vodafone Idea. The spectrum dues frozen at $13.8 million annually over the next 6 years. That's according to an exchange filing. So some reassuring news for Vodafone Idea. Their stock's up at the moment 5.5%. Okay, here are some more stories that we are tracking on the deals front. Paramount Skydance has reaffirmed its hostile offer to buy Warner Brothers Discovery, insisting that its bid is superior to the one from Netflix. This is partly because the Netflix deal plans to hand investors stock in a cable TV spin-off that Paramount deems as worthless. Paramount points to poor market debut of Comcast's cable spin-off Versant. Revolution Medicines jumped in after-hours trading on a report that Merck is in talks to buy the cancer drug maker. The Financial Times says a price of as much as $32 billion is being discussed, although a deal has not been finalized. The two sides may still be weeks away from an agreement, and other studios are also interested in buying Revolution. Coming up, Chinese AI firm Minimax soaring in its Hong Kong debut. We'll hear exclusively from the company's co-founder and COO on their strategy amid the hot AI race. This is Bloomberg. And with that, one of China's largest generative AI startups, Minimax, surging in Hong Kong after an IPO that raised $619 million, backed by Alibaba and Abu Dhabi's sovereign wealth fund. The company is among the first of China's Gen AI firms to go public. And we spoke exclusively with Minimax's co-founder and COO, Yeyi Yun, about the company's growth and expansion plans as it faces hot AI competition, not just locally, but globally as well.
We really focus on the capital efficiency, cost efficiency. So we had only spent around $500 million USD in total. Probably only 1 or 2% of the big giants spending. So we did all the optimization, made innovations on it. Yeah.
How do you compete, though, if you're going to go global? How do you compete with an OpenAI or others that are throwing lots of capital at their business? Is it viable, and what is the technology gap looking like in the next few years?
Actually, I don't think it's a competition. It's more about all the top talents across all the world. They bring the technology breakthrough to the society, to the end users. So you will see each models have pros and cons. So we focus more resources on building the models, building the best product experience to let more and more users from all the world to use it.
We're hearing as well the Chinese government might approve NVIDIA's H200 for China in this quarter, perhaps. Is that something you need to look at, importing more advanced accelerators for your training and the like?
I think in every industry with a really high growth, so when the new technology comes here, so you will see every startups, all the companies, they face resources constraint. Probably chip constraint, computing constraint is only one of the challenges. So in the past, you will see our model performers and our product performers. So our resources is stable. We can get access to all of them. So we focus more on our R&D and foundation models. So we just use whatever chips could make sense for us at that specific stage.
Is your goal to stay indigenously with your chips, locally made chips, or would you buy NVIDIA chips as well?
It doesn't matter what kinds of chips it is. It's more about which chips can give us best ROI, which can help us to achieve our mission to make the best technology accessible to all of the users across the world.
So when does the emphasis turn from efficiency to profitability and also getting that steady revenue growth that will then justify a higher stock price valuation?
So we put lots of R&D resources and innovations on the efficiency part. You will see our API, we have the enterprise business, you will see the gross profit margin of our API is more than 65%, which is probably already one of the highest globally. So we focus more on make the best technology and the best user experience. People will love to pay for the best performers models for their use cases.
You've also come out of a price war, essentially, a race to the bottom, some have called, because you're trying to keep costs down and you want to survive as well. There was a battle of survival, and you have been one of the survivors. But at the same time, the startups are not the only ones. The big players, Alibaba, ByteDance, Tencent, and others. How do you compete with them at a low-cost basis?
Actually, it's not. I don't think that's a price war. It's more about the performance competition. So you need to make your model best, and the people, end user or enterprise customers, they don't choose your model because of it's cheap or expensive. It's more about its performance. So that's the key. As you said, I think it's not about the competition between all these big giants. But it's more about some of them, they are like our cloud providers, and some of their products, they are using our models. So it's more about the collaboration. All these companies bring the foundation models to all the world.
That's Minimax co-founder and COO Yeyi Yun speaking exclusively with Bloomberg's Stephen Engel on the stock's debut. Let's take a look at how Asia markets are tracking at the moment. We're seeing some pretty broad-based strengths there. Minimax, just for the record, better by almost 74% at the moment. The broader Hang Seng index, though, looking kind of flat right now. The Nikkei, one of the best performing indexes we have. It's consumer discretionary stocks leading the way. Those are better by 5%. The Kospi better by 2/3 of 1%. Still to come, Gavical CEO Louis-Vincent Gave weighs in on the outlook for Venezuela's oil sector as top oil executives head to the White House. Also, former Indian Chief Economic Advisor Arvind Subramanian unpacks the state of the Indian economy as tariff talks between Washington and New Delhi stall. All that to come in our next hour of Insight. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Asian stocks are rebounding with the key gauge on track for its best full week at the start of a year since 2023. The gains today being led by Japan. We do have a weaker yen against the dollar. Fast retailing also reporting strong earnings. That yen right now, 157.24. So that's towards the weaker end of what's been a pretty range-bound pattern for the yen over the past few weeks. But the Nikkei performing pretty strongly, better by 1.25%. Got the Kospi performing better too. We did see some initial selling of some of those big tech names, but that theme seems to have faded as the afternoon has progressed. Most of those big names performing pretty well. We've got IT stocks just flat in Korea at the moment, while there's one of the better performing sectors on the Nikkei at the moment, better by 1.1%. Elsewhere, we had the Indian Open about 15 minutes ago. The Sensex still pretty much flat, and we've got Hong Kong's Hang Seng Index also looking flat at the moment, even after their stellar debut from the AI company Minimax, now better by more than 78%. Okay, here's a look at what else to watch today. Traders will be tracking the latest job numbers due out of the US, with a global bond advance stalling ahead of that data. Investors are assessing the likely path ahead for interest rates. Money markets are pricing in at least 2 quarter-point Fed cuts this year. Oil, of course, in focus as well. President Trump is preparing to host a who's who of the U.S. oil industry at the White House. Trump says oil companies will spend at least $100 billion in Venezuela as the U.S. government moves to control the Latin American nation's crude riches. Also, the U.S. Supreme Court going to issue the first decisions of 2026 on Friday, and that means legal challenges to 3/4 of President Trump's tariffs could finally be resolved. Still, a ruling against the trade barriers not likely to spell the end of the policy. Trump may attempt to replicate most tariffs using alternative trade enforcement authorizations. Well, our next guest is a prominent figure in the financial world, known for his influential research and investment perspectives. Let's get to Louis Gave, founding partner and CEO of Gave. Louis, thank you so much for joining us today. And I do want to start with one of the big moves on the M&A front today, this potential merger, which has been talked about for a long time now between Glencore and Rio. There's a suggestion that that is now back on the table. Do you have an expectation that this time this deal could go somewhere, and what could the implications for metal markets be?
I think the implications are bullish. Obviously, I have no particular insights as to whether it is going to happen or not. But but by the time it hits the headlines, you have to assume that it's pretty well advanced. So, look, I think it's a big deal. Typically, big mergers in the commodity space happen either at market bottoms or at market tops. You may remember in the late 90s we had BP Amoco, we had ExxonMobil as oil was bottoming, and the consolidation in the sector marked the next big up leg for the entire industry. Now, when you look at Glencore, when you look at Rio, their share prices, Glencore's especially, has been languishing. It's had a halfway decent year, but on a 5-year view, on a 10-year view, it's been nothing stellar. So it doesn't look like this is a merger happening at the top. It's a merger that is happening, because adding supply and adding capacity is very, very tough. And perhaps taking out competitors is the smarter plays than trying to develop new mines. So I think this is bullish for the sector, and it's bullish commodity prices in general.
Yeah, I mean, as you pointed out at the start there, Louis, I mean, nobody really has any details on what the contours of a deal could look like, but there are certainly plenty of questions, and I wondered if you had an opinion on this one. I mean, Rio Tinto has walked away from coal. Glencore is awash in coal. Does this suggest that ESG is being replaced by pragmatism?
I think so. And to be honest, you got that confirmation. You'll remember a few months back, President Trump went to the UN and essentially berated the Europeans for their green energy programs. President Trump made the very clear statement that, look, in a world in which electricity is going to be a determining factor for growth going forward, cutting yourself off from coal seems very, very short-sighted. Today you have China that obviously still uses coal massively, and as a result has a much cheaper cost of electricity than anybody else out there. And not only a cheaper cost, but a much greater capacity of production. Today, China produces more electricity than the US and Europe combined. So if you want to be competitive with an economy like China's, you have to use the same tools at the very least. So, I think ESG, the ESG craze probably peaked, a couple years ago. We're now in a very different phase of great power rivalry, and in this great power rivalry phase, starting off with the higher cost of electricity, because using coal for electricity is still the cheapest price. Starting off with a higher cost of electricity, you're tying your hands behind your back.
We must remember, though, that China also has one of the highest rates, if not the highest rate in the world, of installation of solar and manufacture of solar
Absolutely.
panels as well. And this sort of circles back to the first point that you were making about overall bullishness when it comes to the metal sector. How do you see copper demand evolving over the coming decade or so? Is this a one-way bet, or is there a risk of a glut building?
Well, look, first of all, I want to quickly come back to the point you made on China, because when you look at energy, there's three factors. You look as whether it's cheap, whether it's reliable, and whether it's green. And I think, when it comes to China, they always looked first and foremost at reliability. That was their first priority. Their second one was cheapness, and the third was green. And, they went down solar, they went down nuclear, they went down wind, because it allowed them to diversify their resources, and it allowed them to essentially look to a future where they could import less energy. So for them, solar, really the first characteristic of solar wasn't as much that it was green, but that it was reliable and given their own parameters. And I think in the Western world, we got the equation wrong. We went first for green, then reliable, and then cheap. And as a result, we're facing political backlash as electricity prices now are going up in Europe, they're going up in the US. Look at the US. The natural gas price in the US has gone from $10 to $4 over the past 15 years. And the electricity price over the same period has gone up 80%. So something is a bit wrong there. Now, to your point, and to this point, in the Western world, we have either malinvested or underinvested in our electricity grids, and we now need to catch up. It's that simple. And so, yes, the demand for copper is bound to be very, very strong, just as the demand for aluminum will be very strong for the next, I don't know about the next decade, but definitely the next 3 to 5, because we need to catch up on our electricity grid investments.
So with that in mind, what sort of allocation do you have to metal sectors at the moment? How much more upside do you see here?
Look, I think what's been fascinating in the metal sector is the bull market on metals essentially started 3 or 4 years ago when we when the Western world seized the Russian assets following the Ukraine war. That led to a massive gap up in gold, which has continued ever since. Then it leaked into platinum, then it leaked into silver. Now it's leaking into uranium, into copper, and into nickel. And I think the bull market is just getting started, to be honest. It's also leaking into aluminum now. The bull market in metals, it started in precious metals, and I think in the past 6 months, you've started to see it leak into industrial metals. And usually these moves, it's the moves in commodities are very often the precise opposite of stocks. In stocks, you say you take the escalator up and the elevator down. In commodities, you take the elevator up and then the escalator down. And for the industrial metals, if I think we're like 3 floors up on a 15-floor building inside the elevator.
Louis, I'd be interested in your take also on the events that we've seen over the past few days in Venezuela. It's been very dramatic. And, of course, on Friday, the president will meet with, a who's who of the U.S. oil industry with a view to tapping Venezuela's substantial reserves. There are a tremendous amount of barriers here, however, in terms of the infrastructure investment required, security risks, also the very weak oil price. How realistic do you see it and the timeframes involved in getting that Venezuelan oil to market?
That's not going to happen. I mean, that's, the Venezuela infrastructure, as you just highlighted, is derelict. They've got 2 functioning oil rigs. And oil companies aren't even investing in Texas or Saudi Arabia right now with an oil price at $55. They're definitely not going to pour tens, if not hundreds of billions of dollars into Venezuela to get up to grade. This isn't to say that Venezuela doesn't matter. Venezuela matters tremendously because of the messaging of the White House around Venezuela. Following the removal of Maduro, what did the Trump administration do? The Trump administration came out and said, hey, Colombia, Mexico, Greenland, you guys are next. That's a pretty powerful message to send out, especially given the precedent that I've already highlighted of 2022 of freezing the Russian assets. The reason I come back to this is that for 70 years, our entire financial infrastructure rested on the idea that you saved in U.S. treasuries, so that, if you ever had a natural disaster, a calamity of some kind, you could transform these treasuries into commodities at any one time. With the Russian war, we said, you know what? Your access to treasuries depends on us liking you, on you being a good guy. Now, with the removal of Maduro, the message that the U.S. is right now sending to everyone is you get access to commodities if we say you do, if we like both the producer and the consumer of commodities. Now, imagine right now if you're Greenland, if you're Denmark, you have all your reserves in U.S. treasuries, and you need to buy oil over time. And now the U.S. is essentially saying, we decide who gets to buy oil. So as I look at what's just happened in Venezuela, my conclusion is that any country that has aspirations to run their own independent foreign policy, any country that may want to disagree with the United States every now and then on something, will have to transform some of their U.S. treasuries into commodity inventories. So take India as an example. India has $600 billion in central bank reserves, mostly in U.S. treasuries. India imports, 1.7 million barrels or so of oil from Russia. At its peak, it imported as much as 800,000 barrels a day from Iran, out of an import of roughly 4.5 million barrels a day. If you're India today, do you turn around and say, you know what? Maybe I should build up a bigger strategic petroleum reserve. Instead of having 600 billion in treasuries, should I have 500 billion in treasuries and 100 billion in oil? Because tomorrow the U.S. can say, you know what, India, unless you do what you're told, we're not going to deliver oil to you anymore. And so I think, the Venezuela thing matters a lot, because all around the world now, everybody, suppliers, producers, countries, I think are going to have to build up bigger commodity inventories.
Louis, to your point a moment ago when you said that this exploitation of Venezuela's oil reserves just isn't going to happen, President Trump doesn't particularly like hearing things that don't fit with his world view. Will he need to, do you think, offer subsidies, security guarantees, other incentives to U.S. oil companies to get involved in this project?
Maybe he will. But you're also starting off then with a position where the U.S. is already running budget deficits of 6.5% of GDP. It's all very well to say we're going to spend 50 billion here, 100 billion there, etc. But 100 billion here and 100 billion there, after a while it starts to stack up. So you want to throw money to rebuild the shipping industry domestically. You want to throw money to rebuild an aluminum industry domestically. You want to throw money to build a rare earth supply chain. You now want to throw money to build oil production in Venezuela. Now, by the way, if that does happen, imagine you're a U.S. oil producer and you're now told, you know what, I'm going to give you a bunch of money to increase your CapEx in Venezuela. You'll say, fine, I'll take that money and I'll cut my CapEx in Texas. I'll take the free money to do it over there, and I'll do less with my own money over here. Again, the reality is a $55 oil. So you can perhaps increase the CapEx in Venezuela, but then it's going to get reduced somewhere else. So the idea that we're going to have this surge in capacity when the oil price is $55, to me seems very, very far-fetched.
In terms of all the spending that you just listed there, I'd add another one to that list as well. The President today directing Freddie and Fannie to purchase more than $200 billion in mortgage bonds, kicking private investment out of single-family homes as well. I can't resist. This looks like socialism.
So I actually did a meme on this because yesterday Trump said, I can't remember precisely what he said, but he said, homes are for families, they're not for corporations. Now remember, in 2015, Xi Jinping said houses are for living, not for speculation. And that pretty much marked the top of the Chinese market when that was said. Housing is always a massively important sector. It's a huge important employer. It has massive multiplier effect on any economy. And so today, if you're a property developer in the U.S. and you have the president coming out and saying, we're not going to let institutions, buy housing in the future, does that make you want to invest more? Or does that make you want to invest less? The problem with intervening in markets that kind of function is you pull on a string and you never know what comes out. And so today, President Trump is indeed saying, look, we want, it's the same thing as oil. It's drill, baby, drill on the one hand, and I want an oil price at $50. And you can't have both. If the oil price at $50, people aren't going to drill, baby, drill. And today, he's saying, I want interest rates at zero across the board in the U.S. and at the same time, and I'm going to throw a lot of money at Fannie and Freddie, and I want house prices to go down for young families. Those two things are sort of opposite. If you collapse interest rates, house prices are going to go up. And if you think that you remedy this equation by saying, well, I'm going to remove one of the buyers in the market, i.e. the institutional investors, the end result of that may actually be less supply. So you reduce the interest rates, you reduce the supply, and you think you're going to reduce the price. To me, that seems like wishful thinking.
Does this also seem perhaps that it's more about optics heading into the midterms?
You think? No, surely not. Yes. You have to wonder when you see the tweet storm that has been unleashed in the past 48 hours of attacking the institutional investors who buy real estate, the tweets attacking the defense companies for giving out dividends and buying and doing share buybacks, the tweets to impose 500% tariffs on China and India for doing trades with Russia. It's been like coming on all cylinders, firing on all cylinders in the past 48 hours. You do wonder whether President Trump maybe has been shown some pretty poor poll numbers for the midterms. Poll numbers that, to me essentially make sense, because I think when you look at Trump's coalition, a not insignificant part of his coalition was the America First crowd. You think the Marjorie Taylor Greenes, you think the Rand Pauls, the Thomas Masseys of this world, that part of the coalition that joined Trump on the promise that there would be no more foreign adventures, that there would be no foreign wars. And that part of Trump's coalition is, I think, very, very disappointed today. Again, you see it in the behavior of Marjorie Taylor Greene, et cetera. So I think that part of the coalition is peeling off.
Louis, we do want to get to your investment views as well, and I'm particularly interested in your approach to China at the moment. What sort of allocation do you have? What's your outlook?
Well, look, I think China started a structural equity bull market. With my own money, right now I'm 45% into Chinese equities, and I've been for the past few years, essentially since the intervention in early January 24 of the authorities in the market. I think the authorities have made it pretty clear that they're essentially have a put 15% or so below the market. You've seen intervention a few times. And for me, what's fascinating today in China, the big development of the past few weeks, and I think one of the reasons reflation trades are working everywhere in the world right now, because, we mentioned metals, we mentioned copper, but you're seeing financials outperform everywhere around the world. You're seeing yield curves steepen everywhere around the world. And that corresponds to a very simple reality, is that the renminbi is now moving up. The renminbi is, if there's one anomalous price in the world today, it has to be the renminbi. The renminbi is so stupidly cheap that China today is running a trade surplus of 100 billion US a month. Even more than 100 billion. It's 1.3 trillion a year. Put things in perspective, 1.3 trillion is Saudi Arabia's GDP. So China's trade surplus right now is Saudi Arabia's GDP. You've never seen that in the history of modern markets. This is just completely out of whack. And what you're now seeing, so the renminbi has been grotesquely undervalued, and it is now moving up. The renminbi has now gone up 27 days of the past 31 days. It's gone up 22 days in a row over the past 22 days, which is highly unusual. Usually, it goes up 3 days, down, down 2 days, etc. To have continuous rise like this, it's very clear to me that the PBOC is signaling both to its domestic exporters, to its domestic investors, the renminbi is now moving up. It's moving up because China no longer needs to subsidize its industry to protect it from U.S. attacks. China spent the period 2018 to 2025 de-Westernizing its supply chain and protecting its economy from U.S. attacks. The trade war is now over. That was the big message of 2022 when Trump says we're now in a G2 world, when the U.S. backed off from attacking China because it realized that actually, it didn't have as much it couldn't put on as much pressure on China as it wanted to. All of these factors now lead China in a much more reflationary policy, which includes rising the currency to now favor the domestic consumer. And so in an environment of rising exchange rates, an environment of trade surpluses that are absolutely through the roof, an environment of massive policy support from the government on Chinese equities, you've seen Chinese equity be the best market in the world in 24, be one of the best markets in the world in 25. And to this day, very few people are exposed to it. So I think there's a lot of exciting things happening in China for investors.
All right, Louis, thank you so much for your time and your insights today. Really great conversation there. Louis Gave, founding partner and CEO of GovCal. We have plenty more ahead. This is Bloomberg. Let's take a look at shares in LG Energy. They're reporting a surprise preliminary operating loss for the fourth quarter. This is amid slowing demand for electric vehicles, including the rollback of subsidies in some markets as well, casting a bit of a cloud over South Korea's largest battery maker, off about 1.5% right now. So an operating loss there of 122 billion won. That's $84 million in the 3 months to the end of December, and that missed analyst estimates. For a 33.1 billion won profit. So, a bit of a shortfall there. So, LG Energy Solution a little bit softer, but the broader market performing pretty well. The Kospi better by more than 0.5% at the moment. The Nikkei leading gains across the region, better by 1.3%. Up next, we'll unpack India's growth forecast. The country expecting growth of more than 7%, despite pressure from US tariffs. Former Indian Chief Economic Advisor Arvind Subramanian gives us insights next. This is Bloomberg. Welcome back. You're watching Insights. Here's a quick look at where markets stand at the moment, particularly Indian markets. There's a bit of quiet day to round out the week. We do have the Sensex there, only better by a few points at the moment. One idiosyncratic story out of India, a stock-specific story. Relief for Vodafone Idea. The government capping payments for past dues of spectrum use to $13.8 billion. So a lifeline there for Vodafone Idea. Shares higher by a little under 3% at the moment. But elsewhere, it's let's call it flat on Indian markets. The rupee, meanwhile, still pretty weak, just above that 90 level. For more on the state of India's economy, let's get now to Mumbai. Bloomberg News senior editor Menaka Doshi joins us. And Menaka, we're awaiting GDP figures as well. What are we expecting in terms of the health of India's economy?
Well, it's looking good, Paul. We just got the first advance estimate for the GDP growth for FY26. That's the year ended March 31st. It's come in at 7.4%. That makes India the fastest growing major economy in the world. That growth is coming on the back of renewed government activity, because the year before that, government activity was subdued on account of a national election. We're seeing some signs of pickup in corporate investment. Services, which is the backbone of this economy, has been strong, and there has been an upsurge in manufacturing as well. Now, we spent all of last year, Paul, talking about the trade trauma that India is facing on account of the 50% US tariff that President Trump has imposed on India. That did not have a significant impact on this GDP estimate for a couple of reasons, and I'll run through them. Firstly, India is mostly an inward-looking economy. At worst, economists had estimated and up to 0.5 percentage point impact of the US tariffs The consensus was between 20 to 30 basis points. A couple of factors playing in here. Key sectors like electronics, pharmaceuticals, exempt from those tariffs. And, job-intensive sectors like textiles, gems and jewelry that were impacted by the tariffs did do significant front-loading ahead of the tariff becoming effective. So we haven't seen the full impact of that play out on the Indian economy. And even if it does, it's not going to be significant. So here we stand at 7.4%. The bigger question is, what will next year look like? And I can't think of a better person to answer that than Arvind Subramanian, former chief economic advisor and also, more importantly, co-author of a seminal book on India's economic history, A Sixth of Humanity, Independent India's Development Odyssey. Arvind, thank you very much for your time this morning on Bloomberg.
Thanks for having me, Menaka.
Let's start with that 7.4% number. What's your quick takeaway from that? But more importantly, what does that mean for the next fiscal, the one or two things that you're looking at closely?
Well, firstly, can I just sound a note of caution on the 7.4 number? I think there are two things that that number we should, which we should make us read it cautiously. One is the age-old issue of, is it well estimated? Are the deflators right, et cetera, is one. But even directionally, as you know, it's not obvious that the economy is recovering because, for one thing, all the nominal indicators are decelerating. Even nominal GDP is decelerating. And many of the high-frequency indicators are also slowing down. So I think we should be cautious about both the level and the direction in which the economy is headed. And of course, remember that one sign of caution, of course, is that in the last few months, the rupee has come under pressure. Now, it would be very, very odd for there to be capital fleeing a country where apparently the growth is 7.5%, which is so much greater than anywhere in the world. Something odd. Those two don't completely connect. So just a note of caution about, where we are even today on the performance of the Indian economy. Now the next question, looking ahead. I think one has to be a little bit anxious because let's not forget that India has suffered two major external shocks. And let me explain them. The first, as you said, Menaka, very rightly, is the tariff shock, which is, as you rightly said, the headline number is worse than the actual number because of the exemptions. But on the other hand, it's now looking less likely that there will be a trade deal than more likely. And it's maybe looking likely that, the tariff numbers may be headed upwards too. So I think the tariff shock has not gone away by any means. That's the first shock. The second shock is, of course, Chinese mercantilism, that China has started exporting very rapidly and it's diverting its exports to developing countries, including India. And that too will put pressure on India. So I think that one has to be a little bit cautious. The fiscal deficit has deteriorated, for one thing. So the macro position is, while it's reasonably strong, it's not as, the fiscal situation because of the GST cuts is not as strong as should be. The million dollar question going forward is when and how will private investment recover?
And you don't think or you don't agree that there are signs already of a very nascent, recovery in private investment?
Well, the order numbers are up, but, remember, real credit to industry has again decelerated from not very high numbers. So we'll have to wait and see. Let's put it this way. I can't be confident in saying that I see a recovery. If anything, many of the indicators are, especially the nominal indicators, are slowing down. Electricity, for example, has slowed down considerably. Consumption of steel has slowed down considerably. So, but that's not to say other indicators have not recovered. But on balance, nothing that will give you confidence that there's a serious improvement in private investment because, and this is where I think the connection with the book is important, what is one's diagnosis of why private investment is weak? Because remember, the macro is sound, the banking system is flush with money, public infrastructure has been built up, and yet private investment has been weak and not shown any sign of sustained recovery. So the question is, what is the diagnosis? We have a diagnosis that stems from the book. I'd be happy to share it to sort of strike a slightly note of caution.
Yes, well, you've written, extensively in the book of how India has throttled private enterprise, and even the deregulation that took place after 1991 wasn't adequate. We are in another round of deregulation right now, Arvind. I want to bring it to the now and present. Do you feel that the government is gripped significantly with all the challenges that you've listed? And I can add to that, right? For instance, the GDP number suggested that there has been a moderation in consumption, though this year we had hoped that consumption would in fact pick up on the back of that the series of tax cuts. So do you feel the government is gripped enough, is doing enough, and what more does it need to do?
Correct. I think it's a very fair question. I think the government deserves a lot of credit for having recognized that, the combination of the domestic economy and external shocks requires a really serious policy response. And to their credit, they have responded very strongly. For example, they cut GST rates to boost consumption. They have cleaned up the labor code, which was long overdue. And most importantly, they repealed these horrendous quality control orders, which were just a form of naked protectionism. And they've also enacted, a reform of the insurance sector, the nuclear liability, and so on. So I think policy-wise, the government has responded because it's aware of how serious the challenge is, how, adverse the external market has changed. But Menaka, the key question is, will investment respond? And here's where, I've written in the past that my diagnosis of why private investment is weak is because the risks of doing business in India still remain elevated. And what are those risks? First and foremost, arbitrary government action, weaponization of the state to target, groups and so on, which is spilling over into how investors feel, if they were to make long-term investments, are they secure that, something will not happen to undermine those investments? The second big reason is something we've called national champion risk that favors to some big companies and groups, has dampen the incentive of other investors to enter the space where these big conglomerates are. So that's why I think that's another thing. And of course, policy reversals keep happening, and therefore protectionism being a good example. So the government really has to work to reduce the risks of doing business. It's not just about increasing the returns, which they're doing to their credit. Corporate taxes were cut, and all of those things. But is the investor environment less risky, or do the risks remain elevated? I think that's the million-dollar question.
All right, assuming that the government, is aware of this and will work towards it at whatever pace, that an economy like India allows, what do you expect will be the growth outcome for next year? Because markets are forward-looking. The 7.4% number is backward-looking. Everyone is expecting on this base a lower number. What are you looking at? Like close to 6%, 6.5%? And what role will inflation and the rupee play in this?
Yeah, let's turn to the rupee for 1 second. There's been a massive external shock. As you know, some labor-intensive sectors have been pretty badly hit: gems and jewelry, apparel, fisheries, and so on. So what the export sector needs is support. There are two ways it can get the support, either via the government, which now is less and less in a position to provide that support. That's why there hasn't been much. or the support comes from a declining rupee because, as you know, a depreciating rupee is an export subsidy, right? But, the Reserve Bank still seems to be reluctant to allow the rupee to be fully flexible. And I think that's a policy response that needs to be looked at more carefully. So that's on the response side. One has to be cautious about next year. I don't want to put a number. I think if at the end of the year, the growth numbers are similar to where they were this year, I think India should consider itself both lucky and job well done, because the uncertainty has gone even higher now. I mean, there's threat of a 500% tariff on countries buying Russian oil. So I think that's going to be very important. Now, Menaka, one thing, can I just a little bit push back at something that you said, that, so
Sure.
far the impact of the tariffs have been small, right? And you're right. I mean, so far, it's short run. But, in the medium term, the impact of this tariff shock should be viewed not from the perspective of, how much exports have we lost in the short run, but rather what it does to the long run China plus one opportunity. Remember, India was very well positioned to take advantage of that, even in manufacturing. After all, the iPhone is a great example. But if because of the tariff shock, because of the elevated uncertainty, even the risk that tariffs might go up, investors will be even less keen to relocate to India. So that foregone development opportunity is the real risk of the real cost of the external shock, as it were.
All right, we have just a few minutes left. So, Arvind, I want to ask you a quick follow-up question on the rupee. Are you saying that you think that the Reserve Bank should have allowed for faster depreciation well below the 90 to the dollar level? Because, there has been considerable intervention, but the central bank says it's simply to smooth out volatility.
Yeah, I think, the last 6 months have been better than in 24 and 23, when the rupee was basically the de facto peg. This is better, but there's still been a lot of intervention. The intervention is well above what is required to make a smooth volatility, because the numbers are big, at least 30 to 40 billion on the spot market, similar amounts in forward markets. And we know they're partly responding to pressures not to let the rupee fall too much, because all nationalist governments don't like seeing a depreciating currency. So I think that I wrote recently that there should not be pressure on the RBI to target any level. There should be much more flexibility than there is, and of course it should not be dramatic. It should be gradual, because that is the only response to the large external shock today and in the future that India faces.
All right, one last question. We just have a minute or so. This is going to be the year of key state elections. You've written extensively about the center-state relationship in your book, Arvind. Investors will be looking to India to say, is this relationship souring? And does it impact, in many ways, autonomy of states, growth of states, and therefore the overall growth of India? Very complex, but can you distill your outlook in 30 seconds?
Well, there I'm a bit more hopeful, actually. While relations between the state and the center, there's been some diminution of trust over time for all kinds of reasons. However, states still have a lot of agency to undertake and attract investment. We've seen that already. Some of the southern states have attracted a lot of investment, even in manufacturing. So as long as there's kind of this competitive federalism, as it were, states, take the initiative, make the environment less risky. In fact, that's how Tamil Nadu and the southern states have been able to attract investment. They've reassured investors that if they come in, they will be protected in legitimate ways. And if some more and more state governments can do that, I think that is the hope for growth going forward. Competitive federalism and actions by the states that the center has not been able to do, in fact.
Thank you very much, Arvind Subramanian, for your time this morning. Congratulations on a fantastic book that documents India's economic history for the last 7 decades.
Cambodia's Deputy Prime Minister says the country wants to lower the temperature in its dispute with Thailand to protect a fragile ceasefire. Speaking exclusively to Bloomberg, son Chanthol also pushed back against Bangkok's assertions that the clash was part of a battle against scam centres operating across the border.
Well, the ceasefire is still fragile, but I want to reassure you that Cambodia committed to the ceasefire. Cambodia need peace, and I'm sure Thailand also need peace in order to build our country, our respective country, for the benefit of our respective citizens. So we are committed to resolve the conflict through a peaceful means. We have different mechanisms in place. We have GBC, General Border Committee, we have JBC, Joint Boundary Commission. Cambodia and Thailand will be neighbor for next thousands of years. So let's work together to develop our economy for the benefit of our people, for the benefit of ASEAN. We cannot have a conflict or else we lose the credibility of ASEAN. So I hope and I wish that this conflict can be resolved peacefully, sooner rather than later. And I'd like to take this opportunity also that we need to lower the temperature. The Cambodian citizen, also the Thai citizen, let the government work together to find a peaceful resolution. Do not add fuel to the fire.
Thailand has kind of framed the recent strikes as an assault on scam centers. And I wonder if Cambodia sees any truth in that.
You cannot use one issue, the scam, to invade the country. That's my own opinion. If the scam center happened in Cambodian territory, the government of Cambodia has the obligation, the right, sovereign right, to resolve them themselves. We don't need the third country to come to resolve the scam center in Cambodia. Cambodia authority arrested and deported Chen Xi, the head of Prince Group, to China. It took us a while to investigate, to collect all the information, and we took action. So when we have all the evidence, we took action according to the law of the land.
Last year in April, Cambodia was among the top of the list of President Trump's tariff rates. It was very high, over 40%. You led the negotiations for Cambodia. The rate is now 19%, much lower. Now that a few months have gone by, I do wonder what has been the economic impact of those levies so far.
2 days after the announcement, our Prime Minister sent a letter to President Trump, offered to discuss, to negotiate in good faith the trade between Cambodia and the U.S. I believe that Cambodia was the first country that concluded a comprehensive reciprocal trade agreement between Cambodia and the U.S. Now, we are continue to discuss with USTR regarding certain sector that we believe should receive a lower reciprocal tariff. For example, the garment, the textile, the footwear, travel goods that employs nearly 1 million workers, predominantly women. So we ask USTR to reduce those important sectors for Cambodia for potentially reducing or zero out those sectors. It's important for Cambodia.
There's lots of investment across Southeast Asia from China, and I understand Cambodia is a beneficiary of that as well. Has there been any noticeable kind of uptick of investment from China as a result of these tariffs?
The average, I would say, around 50% of our FDI come from China. We are trying to diversify our portfolio by going to different countries. I went to Europe a few times. I went to the US a few times. I went to Japan. I went to Korea. I went to Australia and other countries, try to promote investment from other countries to Cambodia. Having said that, our law on investment does not discriminate against any investor. As long as they respect rule, regulation, law of the land, we review it and we approve the project. So I take this opportunity to encourage companies from the US, from Europe, from around the world to consider Cambodia as a place to invest.
That's Cambodia's Deputy Prime Minister Sun Chanthol speaking to Bloomberg's Philip Hymans. Before we go, here's a look at our guests for next week. On Tuesday, the TCS CEO joins us for an exclusive interview to unpack the Indian IT giant's third quarter earnings. Plus, we discuss how AI is changing the labour market with the MIT professor and Nobel laureate Darren Akimoglu. More on earnings with HCL Tech CEO, and Indosuez Wealth Management offers guidance as traders navigate geopolitical upheaval. But that is it for Insight. Horizons Middle East and Africa next. This is Bloomberg.